Gold spikes. A fast rise in gold is a clear fear signal. Capital leaves risk assets and parks in a store of value. This shift appears when trust in banks, money, or policy weakens. The mechanism is simple. Gold moves when the alternatives look weak. If inflation is high and the interest earned after inflation is low, holding cash or safe bonds doesn't add much to savings. Gold pays no interest. But when those alternatives pay little in real terms, the cost of owning gold is small or even null or negative. Large buyers like central banks and big funds can add demand quickly. Because new gold supply grows slowly, that extra demand runs into limited supply. The result is a fast climb in price. A visible pattern often forms. Spot prices lift first, then futures follow. Flows into gold funds pick up. Reserve managers add to official holdings and keep the floor firm for months. Analysts watch these pieces together to judge whether the move is narrow or broad. During the global financial crisis of 2008, the price of gold rose about 100% in 4 years. During the 1979-1980 inflation shock, the price of gold rose about 276% in 12 months. During the COVID-19 shock of 2020, the price of gold rose about 27% in 7 months. If gold surges when fear surfaces, the yield curve shows how fast credit will start to slow. Yield curve flips. The yield curve shows the relationship between yields and time to maturity for a set of comparable debt securities, or bonds. It is basically a simple chart that shows the price of borrowing over time. In normal times, the curve is upward sloping, meaning that long-term rates are higher than short-term rates. In other words, borrowing money on longer time frames costs more. This makes sense as money is tied up for longer. There's more time for surprises like inflation or policy changes, and lenders want extra pay for that extra time and risk. This is a signal of a healthy economic and financial scenario, as investors expect higher rates or steady growth ahead. When short-term rates move above long-term rates, the curve inverts. The cost of borrowing money for short time frames becomes higher than the cost of borrowing the same amount of money over a longer time frame. It signals that markets expect weaker growth and future interest rate cuts. This is especially hurting banks. Banks get their money short-term from deposits of customers or wholesale funding and lend it long-term for mortgages or business loans. If short-term rates are higher than long-term rates, banks pay more to get money than they earn on loans. What happens next is that with little profit per loan, or even a loss, banks pull back on lending. When banks lend less, credit becomes harder to get for families and businesses. That is the core mechanism. Then, depth and duration of an inversion matter. Deeper and longer inversions are more troubling than brief ones. In the United States, the 10-year minus 3-month Treasury spread is the 10-year government interest rate minus the 3-month Treasury interest rate. It inverted 3 times in the last years, and each time a remarkable crisis occurred. In 2000, the spread flipped below zero and stayed there into the whole 2001, when the dot-com bust occurred. In 2006, the spread turned negative and hovered near zero through parts of 2007. The Great Recession that spanned from 2007 to 2009 indeed started in December 2007. In 2019, the spread inverted before the pandemic recession. It then moved back above zero before COVID exploded. The recession began in March 2020 for a different reason, but the earlier inversion had already flagged a fragile backdrop. If the curve warns that credit will slow, the next sign shows up on the factory floor as new orders shrink. Factory orders fade. Purchasing managers' indexes are fast surveys of factory conditions. Managers report on new orders, production, inventories, jobs, and delivery times. The index usually lives between 40 to 60. A reading above 50 means expansion, whereas a reading below 50 means contraction. The mechanism is intuitive. Orders slow first because firms see weaker demand and cut purchase plans of materials and goods used to make and deliver final products. Inventories then look heavy. Production adjusts by reducing shifts and hours. Hiring freezes follow. Delivery times speed up as bottlenecks clear, which is another sign that demand has cooled. Sustained sub-50 readings across several months are stronger evidence than a single week print. During the global financial crisis of 2008, The US Institute for Supply Management PMI relative to manufacturing fell about 16 points in 12 months. During the COVID-19 shock of 2020, the global manufacturing PMI fell about 11 points in 2 months. During the 2012 Eurozone debt crisis, the Eurozone manufacturing PMI stayed below 50 all year, signaling contraction. If orders dry up on factory floors, developers halt building permits next. Building permits plunge. A residential permit is the official permission from the local government that lets a builder start a new home or a big renovation. Counting permits tells how many new homes builders plan to start soon. Builders stop asking for permits when homes aren't selling, when getting a loan is harder or costlier, or when they think prices will fall. This choice shows up before bulldozers and cranes stop, so it is a leading sign. When mortgage rates jump, monthly payments get bigger. Some buyers no longer qualify for a loan, fewer buyers show up. Builders take longer to sell the homes they already started, but they still pay interest, taxes, and upkeep while they wait. Banks get more careful. New projects that made sense when rates were lower no longer add up, so builders stop asking for building permits. With fewer permits, actual construction slows a few months later, and then hiring slows on building sites. The cool down spreads to companies that supply cement, lumber, windows, and appliances, and to local shops that depend on new families moving in. A big, steady drop in permits for standalone houses people buy to live in is the clearest warning. It shows the core home buying market is pulling back, not just a temporary pause in big apartment projects. During the US housing bust of 2005-2009, total building permits fell about 77% in 42 months. During the early 1990 US downturn, building permits fell about 45% in 36 months. During the 2022-2023 rate shock, US single-family building permits fell about 30% year over year. If permits collapse first, prices follow as the market loses support. Home prices plunge. Home prices link directly to wealth of common people and families. When home prices flatten across many cities and then fall, equity shrinks for recent buyers. Equity is the part of a home that the owner truly owns, calculated as home value minus the mortgage still owed to the bank. Equity can be seen as the owner's cushion. When that cushion is small or negative, even a small problem can push a household into trouble. Therefore, low equity raises default risk and makes banks more cautious. They ask for bigger down payments and approve fewer loans. That means fewer buyers, which pushes prices down again. This loop can run for a long time, especially when many homes are for sale and borrowing is expensive. In order to identify such a warning sign, take a broad price index. In the US, the Case-Shiller index is common. It compares repeat sales of homes of the same category in big cities, so it shows real price changes, not shifts in the mix of homes sold. During the US housing bust after 2006, the 20-city Case-Shiller index fell 34.4% in 66 months. During Ireland's post-2007 housing crash, national residential prices fell about 51% in roughly 5 years. During Spain's 2007-2013 bust, national house prices fell about 37% in 6 years. While housing deflates quietly, a sudden burst in consumer prices can turn caution into tightening. Prices jump fast. Sudden inflation is a stress test for budgets and policy. It cuts real incomes and forces central banks to tighten policy, meaning raise interest rates and make borrowing harder so spending slows and prices stop racing. The mechanism begins with energy. Oil and gas feed into transport and heating quickly. Food follows through fertilizer, shipping, and storage. Businesses face higher input costs. They raise prices or accept thinner margins and lower volumes. Households with fixed payments feel the strain first. Households with variable payments face a double hit as interest costs rise too. Expectations matter as well. If people expect higher inflation, wage deals and price setting adapt, which keeps inflation sticky and forces even tighter policy. During the 1973-1974 oil crisis, U.S. inflation rose about 7.8 percentage points in 24 months. During the 2021-2022 inflation surge, U.S. inflation rose about 7.7 percentage points in 17 months. During the UK cost of living surge of 2021-2022, inflation rose 10.4 percentage points in 21 months. If inflation runs hot, loan and mortgage rates jump as policy catches up. Borrowing costs spike. Borrowing costs are the interest rates on loans like mortgages, car loans, credit cards, and business loans. A spike means those rates jump quickly in a short time. Monthly mortgage payments jump when adjustable loans reset. Refinancing mostly disappears because the new rate is too high. Many new projects get canceled as the loan now costs too much to make the numbers work. Banks also charge extra and say no more often, so borrowing gets harder. Then the money squeeze shows up. Families and businesses must send more of their budget to interest. There's less left for shopping, equipment, or hiring. Prices can feel it too. When rates rise, many investments are worth less today, so stock and property prices can fall. People feel poorer and pull back even more. Put together, housing slows, business spending slows, and hiring slows. The speed matters too. If rates jump quickly, contracts can't adjust in time. Those hurt first are the ones with adjustable rate loans or debts that must be renewed soon, as their payments jump right away. In the U.S. economy, during the early 1980s, the U.S. 30-year mortgage rate rose about 10.6 percentage points in 24 months. During the 2021-2023 tightening cycle, the U.S. 30-year mortgage rate rose about 5.1 percentage points in 33 months. During the UK gilt turmoil of 2022, typical 2-year fixed mortgage rates rose about 1.3 percentage points in 15 days. If borrowing costs spike, markets often lurch next. Stocks crack. Stocks moves on what people expect to happen next. The trend of stocks price is an approximation of crowd psychology in regard to the expected proceeding of the companies that the stocks represent on the market. If many investors think companies' profits will fall or they get scared, they sell. In light of the law of demand and offer, as many people sell the stocks, the prices of those stocks fall. They can drop faster than the economy changes because selling happens in minutes, not months. When prices fall, families and savers feel poorer. Many families own stocks directly or indirectly through pension funds, 401k, mutual funds, ETFs, or other financial instruments. Therefore, they spend less. Companies also feel the pinch. Raising money becomes harder and more expensive, especially for weaker firms. Drops can snowball. Some investors usually use borrowed money or strict rules to buy stocks. When prices fall past certain points, they must sell to cut risk or repay loans. That forced selling pushes prices even lower, which can trigger more selling. A broad slide across many sectors and countries is more serious than a dip in a few big names. When big parts of the market are down together, lenders usually ask for higher interest to fund companies just when those companies most need cash. On Black Monday of 1987, the Dow Jones fell 22.6% in one day. During the global financial crisis of 2008, the MSCI World fell about 54% in 17 months. During the COVID-19 crash of 2020, the S&P 500 fell about 34% in 1 month. If equities seize, the plumbing follows as credit becomes scarce. Credit doors close. Crises spread through funding. When lenders grow cautious, they raise standards, demand more collateral, and charge higher rates. Firms delay projects, shrink inventories, and trim payrolls. Households postpone big purchases. When stress builds, it first shows up in the money pipes that run behind the scenes. Banks start charging each other more to borrow cash for a day or a week. Lenders ask for more collateral to make short-term loans. This means you must hand over more safe assets to get the same cash. Big companies try to sell short-term bonds to raise cash, but fewer buyers show up and the cost jumps. Cash funds shift into the safest government bills and avoid anything riskier. At the same time, banks tighten their rules for new loans. Surveys show more banks saying we're tightening. That's a sign the door is closing for many borrowers at once. This is how a finance problem reaches the real economy. Companies run short of everyday cash, so suppliers get paid late and projects pause. If a company can't renew its short-term debt, it must sell assets quickly to find cash. Quick sales push prices down, which makes lenders even more nervous, and they tighten again. During the global financial crisis of 2008, the TED spread jumped about 457 basis points in days. The TED spread is the gap between what banks charge each other for very short-term loans and what the US government pays. When that gap explodes, it means banks don't trust lending to one another. During the global financial crisis of 2008, the net share of U.S. banks tightening C and I standards rose about 52 percentage points in 3 quarters. C and I standards are the rules banks use to approve business loans. When many banks tighten at once, companies find it much harder and costlier to borrow. During the global financial crisis of 2008, U.S. financial commercial paper outstanding fell about 29.5% in 6 weeks. Financial commercial paper is a very short-term debt acknowledgement document sold by big finance firms to fund day-to-day cash needs. When that market shrinks fast, rolling short-term debt becomes hard, so firms sell assets and cut back. If credit is hard to get, the first tremors show up in hours worked and initial claims. Early labor tremors. Labor markets soften in stages. Overtime is cut first, average hours fall, temporary contracts end, then layoffs begin. These steps appear before the unemployment rate moves much, so they act as early confirmation that weakness is spreading. The mechanism follows the order pipeline. When new orders shrink, managers cut hours to match output with sales. Temp workers go next because those contracts are flexible. If conditions do not improve, permanent layoffs start. Claims data arrive weekly and show the turn fast. Hours data cover broad industries and show schedule cuts even when headcount is unchanged. Together, they provide a clean read that demand is cooling and that firms are preparing for leaner sales. During the COVID-19 shock of 2020, initial jobless claims in the U.S. rose about 6.65 million in 2 weeks. During the 2001 recession onset, the manufacturing workweek in the U.S. fell about 0.6 hours in 7 months. During the Great Recession of 2008-2009, weekly initial jobless claims in the U.S. peaked around 665,000.